Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Should we be worried more about this Omicron, however you want to say it, variant? What would we be looking at if we were going to see a market crash? What we would see is people would be running into bonds, running into the dollar, bonds, or they'd be selling copper, saying that the copper play is done. You'd see your CRB index kind of rolling over, and that's exactly what we're going to look at. So let's take a look at some of these and see what's going on. I've got the 10-year Treasury pulled up. This is a reverse or inverted head and shoulders pattern, so a shoulder, head, shoulder. We've been bouncing kind of back and forth between this little downtrend line, going back and forth just in a sideways motion here for yields. This is a 10-year yield. If people are running into bonds, this yield's going to drop. It's going to drop out and go to the downside. We're going to see it beeline lower if the market, if the Treasury market gets bought up. Yields are going to drop like mad. So people would be running into safety. We're not seeing it yet, so I'm remaining positive on it. I think this is a buy the dip moment. Not at the exact moment. I'd like to see it turn first, the dip, but this would drop lower. Yields would drop lower as people seek safety. We're going to look at the copper to gold ratio, which I have down here in my ratios. This is the copper to gold ratio, and the copper to gold ratio usually leads yields. So when copper outperforms gold and moves up, that means that yields are probably going to move on higher, and it moved on higher from August all the way up. Now we're basically petering out here, and we're at a resistance level for this copper to gold ratio. Let me back way out. It's a huge resistance line coming through here. Now, we break this to the upside, yields are going to go far higher. It did this in the mid-2000s. It broke it in 2004, and that's when oil went ballistic all the way, and this kind of peaked out in 2006. It came up in 2007 and in 2008, and oil peaked right here. And that's when oil took a dive and the whole markets took a dive here. This was October of 2008, where the copper to gold ratio really dove lower. And if I were to go back up, well, first I'll finish here. Let's zoom in on the right-hand side here. So here it is on the right-hand side. We've been just going sideways on a daily analysis here. The line has not broken to the downside. If this thing falls and breaks this support line through here, I would probably start to worry, and we'd probably maybe potentially get a crash. But we're still above support level on the copper to gold ratio, signaling that yields are probably going to remain quite resilient. And that's exactly what we're seeing with yields through here, is they've been quite resilient. And I don't consider this to be a crash. I'm talking about a move, and I'm gonna back out here. I'm going to back out to a 5-year, a move something like where these things really start diving, where this starts diving like this. You start seeing a big move like that, where this thing just blows out. That's when you got to start to worry. And especially here, because the yields really started to dive. And this is February. The market didn't crash till March in the stock market. So if you see a big blowout like this, that's when you worry. And you can see the blowout here, March 20 right there, is when the yields just dove. And that's what I'm looking for. I'm looking for these yields to dive, and I don't see anything yet. Gold also, you'll start to see everything kind of break down, and gold is sitting pretty good from a big picture perspective. Platinum is still above its support line. I'm going to just zoom way out here. We're still above this pattern. Everything's intact. So I still think everything is good. I'm not worrying about anything at the moment. Another one to look at is the oil to gold ratio, which has been tracking higher. Now the oil to gold ratio, it's still kind of in this pattern here. I don't think it's anything to worry about yet. Usually during market crashes, this ratio just blows to the upside. I wouldn't say this is a leading indicator though. But you can watch it. If this thing starts to move, then it's like, all right, we gotta start to worry. But it's still a small little candlestick here, and we'll zoom in here. This is a let's do 1 year. Sorry, In the 1 year, this is the pattern here. We're still inside of it. Yes, it's creeping up, but I don't think it's anything to worry about. I think we're going to find some support here at 28. A ratio of gold to oil at 28 means that oil is a very good deal. Anything around 30 is a smoking deal in history. So 28 is a very good deal to buy oil. And I think it's probably going to find support somewhere, hopefully roughly where it's at, somewhere above this area right in here. So that looks okay. Now here's the Dow Jones to gold ratio. I've got what this looks to be a head shoulder with the neckline creeping upward. We're seeing a break to the downside. What that is signaling is the potential for gold to outperform the Dow Jones Industrial Average. I'm going to zoom back out. That's on a yearly. You can see where that pattern is that I drew in there. I'm going to zoom way out. So this is all the way from the 1900 all the way to today. And we've got an increasing type pattern here. And whenever it's slanted upward like this, usually that's going to result in a very large move to the downside. So I'm suspecting a move to the downside at some point here with the market conditions where they're at, with inflation where it's at. And I think this could go all the way below 6, potentially, this lower support line. It may pause there for a little bit, kind of like a bounce like this, and then all the way back lower. And if you look at some of the big picture patterns on gold and whatnot, like the really big picture, it does look like we have some good strength in those markets. And another one I want to touch on, lumber. Lumber is, let me do a 5-year on lumber. Lumber's breaking out to the upside. This thing bottomed, and we're coming on up. That is one area that is looking quite strong is lumber. And I'm surprised because if you come on back here, we had the crash in the C19 crash, and then lumber rocketed higher. Lumber's rocketing higher here. This was kind of like a back test, like a big kind of blow off top back test, and then we're going to rocket higher again, it looks like. So lumber's acting really strong. Some of these other commodities, yeah, this one could probably break down. Nickel and copper's still being resilient. We're still above its pattern here, and we're doing okay still. It's not blowing out yet. I mean, it's close, but let's hope we hang on here and we can start moving on up. It's still hanging on. So that's what I look for in market crashes. I really look at the 10-year yield to see if people are scared and running into bonds. Because if they're running into bonds, then they know something's up. The banks or whoever, we'll call that the smart money. They know what's up and they're going to run into it. If nothing's really happening and it's just kind of a normal pullback, usually you don't see yields move around too much, and it'll be kind of controlled. So right now, yields aren't blowing to the downside yet. Copper to gold ratios is stable. It's okay. Copper's doing okay. This could be just a normal pullback. As far as I know, it's just a normal pullback. Once we see a bottom, I'd be buying the dip. That's kind of my outlook on this. Hopefully this helps you on what I look at, what I look for in the markets, and hopefully this is just a normal pullback. I don't think it's going to be a full-blown crisis or anything, but it could turn into one. So I don't know the future, but as of right now, everything looks okay, and I'm going to give you the thumbs up, saying that nothing's out of the norm yet. If you guys like this content, give me a thumbs up. Subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.